We're 2 weeks out now from the beginning of the Q3 reporting period. Analysts are very, very optimistic about quarter three. They've actually been ratcheting earnings up here a bit over the last couple of weeks, which is unusual. Generally, they're cutting earnings going into reporting period, but they actually kind of ratcheted those up for Q3 quarter. Again, a little bit unusual, but they're very optimistic right now. Most of those ratchets up are in the Mag 7, not so much for the rest of the index, but you are seeing a lot of optimism from Wall Street. Now, importantly, even beyond that, they continue to be very optimistic on both corporate profit margins and earnings going into 2026. Wall Street currently expects record earnings and record profit margins all the way through 2026. Now, this is despite the fact we're seeing slower economic growth, we're seeing slower employment growth. In other words, what Wall Street's expecting is a re-acceleration in the economy heading into next year. Now, where that comes from, I don't know. We don't have monetary supports. We don't have a lot of these things that we had over the last couple of years. We don't have big spending bills coming in. So I'm not sure where this growth is going to come from, but that's the expectation. Maybe it's all a bet on AI is going to lead to more profit margins because of more job reductions, higher productivity. I'm not sure where they're getting the data from, but that's what they're expecting. And markets are rallying on that because, again, as we increase those forward earnings expectations, that gives investors the ability to pay more for stocks without raising forward valuations, because now the E is going up at the rate where the market is. So again, valuations are kind of stuck at a very high level, about 23, 24 times earnings. But as long as they keep increasing those forward valuations, investors can keep overpaying for stocks. That's the game that we play anyway. Earnings are going to be good for Q3. There's no reason to expect that quarter three earnings just absolutely fell apart. The economy's continuing to chug along. Employment's growing. It's just not growing very rapidly, but things aren't just completely falling off a cliff, which should be supportive of the market, particularly as the Fed does start cutting rates. Now, we can see that. We have some pretty clear visibility on that. We've got some okay visibility going into quarter four. But beyond that, things get really, really we're getting into guessing mode. That's the horizon out there for investors. And again, we can all come in and say, oh, yeah, 26 is going to be great. We don't know that. A lot of things can happen as we get further into 2026. If the employment data continues to grind lower, if consumer spending entrenches, which could be the case in some of the things that we are seeing right now, that's going to cause a potential issue with markets next year because of valuations. And again, go back to the very basics of everything, regardless of what your views are. The only thing that matters is forward earnings. If there's something that comes along that all of a sudden contracts that forward expectation of earnings, then valuations have to be repriced. And that's where your risk in the markets come in. Catch me daily on The Real Investment Show. The link is in the description.